Hello, everybody. Welcome to today's episode of The Daily Dose. Today is Friday, November 4th. I just want to say if you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. I release an episode like this every day that the market is open, and every weekend I will come out with an episode that goes more in depth on the week and just what's happening in markets and the economy. So let's get into it today. Obviously, we were green today, a bounce back day for the stock markets. U.S. stocks were firmly higher Friday, but down for the week as traders assessed monthly employment figures that did little to thwart the likelihood of more aggressive monetary tightening and weighed talks that China may ease COVID restrictions. So, with strong jobs reports still coming out, even if unemployment was a little bit higher than expected, it's still not really something that the Fed would look at as a concern to slow down their hawkish monetary policy. So there's really nothing as far as like a Fed pivot, there's nothing that would point to that whatsoever, especially after the FOMC meeting earlier this week. And if you haven't watched or listened to those episodes, definitely go ahead and do that because there's a lot of information in there. So the S&P 500 advanced 1.4%, while the Dow Jones Industrial Average jumped more than 400 points, or about 1.3%, and the NASDAQ was up about the same. And still, all the indices were down for the week, and this was actually the Dow's first down week in 5 weeks, so that's an interesting little fact. The Dow's actually been doing pretty well as of late. So the U.S. economy added 261,000 jobs in October, while September's reading was upwardly revised to 315,000 from 263,000 previously reported, the Labor Department said Friday. Economists expected a payroll gain of 195,000 last month. According to consensus estimates compiled by Bloomberg, the unemployment rate ticked up to 3.7%. Today's stronger-than-expected report illustrates the difficult task that still lies ahead for the Fed wrestling a resilient labor market and sticky inflation. Mike Lowengart, head of model portfolio construction at Morgan Stanley's Global Investment Office, said in emailed comments, quote, "While the number may be disappointing for investors hoping for a dovish Fed sooner rather than later, keep in mind it was the lowest reading in nearly 2 years, so there could be signs that the market is slowing." End quote. Investors have bet that some signs of a cooling labor market would force the Federal Reserve to scale back on its aggressive rate hiking campaign. But Chair Jerome Powell asserted Wednesday that slight moderations in the data were not enough for a pause on increases, with labor conditions still historically tight. So it looks like they're looking for more of a trend, a lot more data. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers, Powell said on Wednesday after the U.S. Central Bank delivered a fourth straight interest rate hike of 75 basis points. In the third quarter of this year, payroll gains averaged 372,000 per month. Weekly jobless claims, the most timely snapshot of the U.S. labor market, have also come in consistently low, with this week's reading at 217,000. And this chart just shows the unemployment rate on the right here. So this purple one, it shows it going from COVID when it's spiked to 14.7% all the way down. And we've been flat really in 2022 with a slight uptick this month, but nothing substantial at all, as we were around the same amount in previous months this year anyways. And non-farm payroll, that has also been shrinking. So there are signs that maybe the job market is slowing, but not really, and not even close to enough data or any kind of significant trend to where the Fed would steer their course on their hawkish policy. So initial claims are not increasing one bit, DataTrekk's Nicholas Collis said in a note. Simply put, there is still no sign that neither aggressive Fed monetary policy nor the tighter financial conditions that it has brought is yet hitting U.S. labor markets. Central banks across the globe have moved in lockstep with the U.S. Federal Reserve to proceed with a combative path of monetary tightening. raising concerns about the impact of synchronized rate increases. The Bank of England raised interest rates by 75 basis points on Thursday, while European Central Bank President Christine Lagarde said in recent remarks that rates may need to be raised to restrictive levels to drag inflation back to the 2% target. While monetary policy has held investors' attention this week, corporate earnings have continued to rush in. Shares of Block surged 11% after the company meaningfully beat estimates on strong performance in its Cash App and Square payment offerings. And they go on to talk about some other earnings that I'm not really too interested in, honestly. So basically, we got the employment numbers. There's no real trend of the labor market being affected by the tighter monetary policy. So not only was the Fed more hawkish than expected this week, but now we're seeing signs that the labor market is still strong, or at least the data is still holding up. So, I mean, there's no reason for anyone to be expecting a pivot. In fact, Jerome Powell said that maybe rates will have to be higher than expected for longer than expected. So if anything, they're just dragging out this cycle of monetary tightening even further. And if that's the case, we can expect this downtrend and this bear market in stocks to continue. There's no reason for it to turn around. So let's look at the chart. Even though we were green today, I don't really put any weight behind that. We'd sold off pretty aggressively the past 3 days. So a little bit of green doesn't make me think that we're changing that trend at all. Obviously, we could still come back up to this level around the 38.95, 3900, but I don't really see us breaking that at this point. And even if we did, like in the most bullish scenario, we're getting stopped by the 200-day moving average. So even if it broke through this level and this zone right here, we're not getting through that just yet. So what I would expect, again, this is not financial advice. Please do your own research, but I would think that we come back down to these lows for sure. And like I've said in previous episodes, I'm still eyeing the 3250 on the S&P 500. I think it makes sense that if we're going to continue this downtrend, this bear market, and we're still in this economic climate for a few more months, it would make sense that would be the next level, the next leg down. That's what I have targeted there. Obviously, this would be my next one, which is a little bit more extreme, but we're not there yet. I'm not ready to talk about that yet, and I'll talk about that if and when we get to the 3250. So that's what I'm looking at on the S&P 500. I'm going to adjust these zones really quickly on my chart. And then we're going to talk about Bitcoin, because Bitcoin has actually been showing a little bit of strength the last couple of days. It's still in its range. So when I say it's still in its range, it's in between. I'll even say it's between 25,000 and 17,500. That's the range we've been in for the last 5 months. We are showing a little bit of strength here, rallying into the 21,000. But I'm still not seeing anything on Bitcoin that's conclusive one way or the other. We're still in a range at the end of the day, and Bitcoin has had a history of rallying into sell-offs. So is this a real rally? Are we going to end up breaking out? I don't know. I wouldn't even be willing to say that we're in a bullish trend on Bitcoin till we break 32,000. I think we need to break the 21, we need to break the 28, and then we need to get above this level where it really stayed. So what's the word? I coiled here. We had a big level of support here that we were kind of just coiling above after a sell-off, and then it fell through to the range that we've been in for the last 5 months. I think to have conclusive evidence that we're going back into a uptrend on Bitcoin, we need to at least break through this 32,000, and that's what I'd be looking to for the upside. Bitcoin's really volatile, so it wouldn't even surprise me in an extreme case if we got up to 28, 30,000 and then still came back down. That would not surprise me. And let's actually take a look back at some of the rallies we've had. So the biggest rally we had in this bear market is we reached the 33,000 level on the way down, and we rallied all the way up to 47,000. And a lot of people thought that was the end. It was not. So from 32,000 to 47,000, we rallied, and we continued downwards to where we're at today. Again, If we break to the downside through the 17.5 or 17.7, we break through this level here, I'm looking at the 9,000, 12,000 level, as I do believe that would be a great level for Bitcoin to reach next on the downside. So that's what I'm looking at on Bitcoin. Green days today in the market. I'm not really putting a lot of weight into it because the more fundamental things in the market and monetary policy, everything like that, is still staying the same, if not getting worse for equities. So that's what I'm thinking right now. If you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. It would mean a lot to me. Be sure to stay tuned for the weekend episode this weekend. I'll be diving deeper into what's going on in the markets, when we might expect a Fed pivot, what that would look like, and maybe some target prices too on individual stocks as well as the market and Bitcoin. So if you like that, be sure to stay tuned, subscribe, follow, all of that good stuff. Like the video, leave a rating if you're listening to the podcast. And until next time, thank you for listening.